From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, sticky inflation and slowing growth has stagflation in focus ahead of what traders say will be the Fed's final hike, while the riskiest corners of the credit market continue to rally. We begin with the big issue. All eyes on Powell.
The Fed's not done.
I would be shocked if the Fed didn't hike interest rates by 25 basis points.
Jay Powell cannot pivot to a dovish stance.
100% we'll see another hike.
My head is spinning. It's a tough environment.
The inflation data we got,
Core PCE,
suggests that it's hotter than where the Fed would like it.
Core inflation is not really coming down.
Inflation is still well above target.
The data are going to have the Fed hiking further.
Economic momentum is going to be downshifting. Things are definitely appear to be slowing out there.
Every traditional leading indicator of recessions is flashing red.
We've been talking about recession for ages and ages.
The full picture suggests that we will have pressure on the economy.
The underlying uncertainty is now structural.
Joining us now, we have Alexandra Wilson-Elizondo of Goldman Sachs, Sri Sankaran of Morgan Stanley, and Zach Griffiths of Creditsights. And Alexandra, I want to start with you because we have high inflation, slowing growth, and of course, still unresolved issues when it comes to the financial sector. What does the Fed do with all of this?
Katie, we really think we're in that bend, not break stage of the cycle. And what that means is we're going to get some really conflicting data right now. But the most important thing, one of the data points that the Fed is very focused on is on ECI, and we got that point today. And what that showed is on an annualized basis, you're seeing figures close to 5%. That's very far from the Fed's target of, ultimately 3.5 in terms of what they're looking to see there. And if you look at what's happening next week, we get a lot of data. We get payrolls and we get an unemployment rate. And the expectations there are for 180K and a 3.5% unemployment rate. These are frankly just figures that don't align with ultimately getting to that 2% target. And we think that the economy is slowing, but it's just not slowing enough. And so they're going to be very focused on inflation still.
So, Sri, of course, the Fed zero focused on inflation. That continues to be an issue. And at the same time, it's become clear in the last week that there's still issues to be resolved when it comes to the financial sector. Of course, we're talking about First Republic still looking for that rescue plan. When you think about the state of what we're seeing in the banking sector and you weigh that against what's going on in the economy, how do you think the Fed is factoring all of that into their monetary policy plans?
I think over time, the damage caused by the pullback or the potential pullback from the banks or the changes in the regulatory framework, et cetera, will become clear, right? But I mean, for the Fed's decision, it's the data that's here and now that really will matter. And I do agree with the previous speaker. Right now, it's almost as if it is the inflation part of the mandate that they are likely to prioritize. The hope would be that to some extent, the tightening of lending conditions, which is coming through from the banking side, gives them some more kind of rationale for holding on to a pause, but they're probably going to parse that pause as a dual-sided pause, i.e. a hawkish pause in the sense that they do want to buy the optionality of potentially hiking later on, rather than allowing the market to interpret this pause as a prelude to a pivot or rate cutting just yet.
And Zach, let's talk about some of the economic data, because again, it seems that PCE and the employment cost index, again, really driving home the narrative that inflation is still very sticky here. Of course, you got GDP earlier this week. Growth is slowing. You still have the labor market hanging in there, but a lot of people are adding that all together and they're talking about stagflation. Has that entered the conversations that you're having now?
Yeah, Katie, stagflation has been a part of our conversations for a while now and something that we outlined as a possibility coming into 2023. We think it's the least likely outcome, at least from the Fed's preference standpoint, and that's why we think they will go 25 basis points next week. They've shown a clear preference toward hiking too much now as opposed to not hiking enough and finding out in 12 months they didn't do enough and having a stagflation-like scenario. And that's important for the credit markets. We see a true stagflation scenario as the worst possible outcome, both for investment grade and high yield. We currently assign the lowest probability outcome to that situation. And that really comes from the Fed being very serious about fighting inflation now and addressing perhaps some tightening of financial conditions from the banks in the future.
Well, Zach, we heard a similar point from Seema Shah of Principal Asset Management earlier today talking about stagflation. Let's take a listen.
Stagflation, by far, that is the worst case scenario. You know, one of the things that has been underpinning markets to this point is this idea that at some point in the next 6 months, 8 months, is that the Fed is going to start cutting rates. There is a lot of assumption out there that inflation is going to keep coming down. Inflation, if it were to reignite and start moving up, that takes away everything which is underpinning the market today.
And Shri, I mean, worst case scenario or not, how do you invest? What's the stagflation playbook, so to speak?
I mean, the stagflation, the risk of stagflation obviously cannot be ignored, but I think the positioning wise, it is very much where consensus already lies, which is more of an up in quality bias, holding on to the pockets of the credit market where you can weather a meaningful slowdown with respect to the earnings narrative or the growth narrative, and companies which are unlikely to lose access to markets even if rates are held higher for longer. I think the pocket that really becomes or comes to the fore in terms of risk is where you have the layering of over-leveraged balance sheets and also rate-sensitive balance sheets. And for them, the higher for longer scenario that is typically associated with a stagflationary setup, that is going to eventually start mattering a lot more when the maturity walls are coming up by the end of this year or early next year.
And Shri, what do you think the greater risk there is for those balance sheets, for those companies? Is it basically that leverage that you spoke of or that interest rate risk still?
I mean, ultimately, it's a combination of the two, right? Eventually, in a typical hiking cycle, the earnings side of that equation eventually helps kind of limit the damage from higher interest rates. That's both true on the coverage side, that's also true on the leverage side. I think here you're going to have this layering of risk that eventually matters. But if you were to put me on the spot and talk about which of the risk matters more, I would actually argue that it's the coverage side of that equation, i.e. the ability of companies to pay double-digit yields. Even if it were a relatively okay balance sheet, that is going to be quickly challenged. I mean, they can pay it for a short period of time, potentially refinance with very short non-call structures and so on, but these are temporary or stopgap arrangements. A persistent double-digit yield environment is going to be bad, regardless of the quality of the balance sheet.
Well, Alexandra, of course, as we discuss all these risks, we should note that it's the final trading day of April. And if you look at what the Treasury market's done in April, it's not a lot. You're looking at 10-year Treasury yields right now. They're just 2 basis points lower on the month. That is the smallest range in quite a while, at least a few years. What breaks us out of this range?
We think it's very difficult to break out of the range. In fact, the concept of nonlinearity, as you think about the long and variable lags with Fed policy, ultimately keeps us range bound. And if we do get to the point where you get a breakout in yields, we do think that there will be a bid to the market because people are really interested in adding that traditional ballast back into portfolios. In particular, as you're coming into the summer months and you could see some of the, negative news cycle as it relates to the debt ceiling really start to pick up.
Well, let's talk a little bit about the debt ceiling, because whenever I bring it up, people tell me you don't have to worry about it until it starts to show up in markets. And if we look at the T-bill market right now, you see a big discount priced into 3-month T-bills versus 1-month T-bills. Alexandra, when you think about that, when you think about what's being priced in, is it time to start caring?
So there's actually a meaningful bifurcation between the equity market and the bond market, which we've seen on multiple different layers throughout this year. But as to your point, we've seen, 150 basis point inversion between 4-week bills and 3 months, reflecting some of the stress concerns as it relates to the debt ceiling. And you've seen sovereign spreads really start to widen out. But, credit has been relatively resilient, and the equity market is more focused on some of this localized earnings data, which has proven to be actually much better than expected. So ultimately, the tail could be quite large if you saw something akin to 2011. But in that instance, you were also dealing with the European sovereign debt crisis. And so we think that you could see risk off, credit spreads widen, equities down, but not to the same extent.
Well, Zach, come in on that, because to Alexandra's point, of course, you're starting to see dislocations when it comes to the Treasury bill market. But when you look cross-asset, it's really hard to find those types of concerns. Do you see any meaningful spillover in the months ahead?
We think spillover is a very distinct possibility, as negotiations have really been non-existent up until very recently. And when looking at the T-bill curve, I'd even focus on just 4 weeks to 8 weeks, so the 1 month to 2 month. And you can see that there's an intense focus on that early June period. And if you look at income tax receipts that have come out over the past week, they've been a little bit weaker than expected. We do think that brings early June into play. And so when we think about how that spills over into markets broadly, we think that takes place over the next month or so. Maybe we need to get through earnings first. You're starting to see a little bit of upward pressure on credit spreads, and we think that could intensify if it looks like we are looking at more of a 2011-esque scenario. Although we went back and looked at past debt ceiling episodes, the market has gotten a little bit more resolved and pays a little bit less attention each year to the debt ceiling in terms of market reaction. So we think that the move could be widening in spreads and down in equities, but perhaps not to that same magnitude, to Alexandra's point.
Sri, is that your expectation as well, that ultimately we could see these debt ceiling discussions actually impact the credit market?
Yeah, I think that's a fair formulation of the previous two speakers, right? But the one point that I would add there is that the transmission is not just through the market side. I mean, it's not really about the U.S. government defaulting on its debt, but it's actually the delays in payment of other obligations, be it like Fed salary, be it federal employee salaries or social securities, et cetera, which also adds to this concern that you may have more of this slower growth impetus coming out of the debt ceiling side of that equation as well.
Guys, great discussion so far. We're going to dig much more into the credit market next. Alexandra Wilson-Elizondo, Sri Sankaran, and Zach Griffiths. Everyone is sticking with us. And up next, it's the auction block. Six Flags makes its return to the junk bond market as junk bonds broadly outperform investment grade. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block as we wrap up the week, the month, and just the month for issuance. We start in Europe, where the UK received a record level of demand for its inflation-linked notes as investors seek some shelter from persistent prices. And over here in the US, April volume for high-grade sales missed estimates by a wide margin. Expectations were for $100 billion. Instead, we're landing near $65 billion. And in U.S. high yield, this week, Six Flags sold $800 million at a slight discount. Total yearly supply now stands over $56 billion with a 4.4% year-over-year gain. Meanwhile, Amanda Lynham of BlackRock says that despite growth concerns, there are some bright spots.
Even a period of just below trend growth in a higher cost of capital environment should warrant a rebuild of risk premia in corporate credit. Ironically, as Lisa, I'm sure you well know, high yield has actually outperformed IG so far year to date. So for all of the concern about downside risks to growth, we actually haven't seen that manifest in the lower quality parts of the market.
Still with us, we have Alexandra Wilson-Elizondo, Sri Sankaran, and Zach Griffiths. And Alexandra, it's really striking. When it comes to high yield, this is one of the least loved rallies that I can remember. Is that warranted? Should it be?
In terms of, when you're looking from a multi-asset framework and you're thinking about getting equity-like returns without taking on the equity risk, high yield credit actually doesn't look so bad. I mean, you're talking about loans at 9.5% yield, traditional high yield at 9%. Default rates are somewhat low. And if you have the view that default rates will be low and maybe the default side is somewhat longer in terms of this cycle, then it does represent some opportunity to really have some carry in the portfolio while we're, navigating this cycle, ultimately maybe going over year end.
Let's talk about that a little bit more. Equity-like returns. Are you talking about high yield credit broadly or specific type of structures?
Well, this is more just talking about the all-in yield of the market. But if you're looking at some places, even like private credit, you're talking about, mid-teens, low teens type returns. These are, in the recent history, these are like once in a lifetime opportunities to get into some of these deals. So We think that there's a lot of opportunity, but the index level on top is tight. It's hiding some of the sins that are under the hood, and we have seen some bigger, cap structures and names default recently. But ultimately, this could carry on for some time. And to your point, yes, it's unloved, but it's been sort of consensus to fade, the negative convexity of high yield. But it's going to take some time here.
And Zach, I'm curious at what point FOMO starts to kick in, because we talk about the concept of the fear of missing out all the time when it comes to equity markets, but just watching junk continue to rally. And when I say junk, it's also the riskiest types of junk. So I'm talking triple C really lead this rally. At what point do investors who had maybe been going up the quality curve say, all right, I can't ignore this anymore?
I think that's a great point, Katie, and it kind of gets back to what we saw at the start of the year, a really big rally across credit, really across the different ratings levels. And so when we think about going forward, when does it get to be that point? If we have a little bit more clarity on the monetary policy front, let's say we hear from the Fed next week, they go 25 and they're on pause. We still have economic growth remaining positive. We have many companies that have been able to term out debt over the past couple of years. So we don't have a maturity wall concern over the next couple of years still. And so we think that that kind of backdrop where some of this macro volatility that we've had over the past month or so with the regional bank situation, if that starts to come off, we think it creates a situation where you could see spreads tighten even further back toward our year-end target of 400 basis points on high yield. So we do think there could be more of that fear of missing out aspect, but we're going to need to see what the Fed does next week, what the ECB does, and get a little bit more clarity on the monetary policy front first.
So a bullish case can be made there, but to your point, it comes with a ton of nuances. Shri, it's notable that despite this rally that we've seen both in investment grade and in high yield, financials have definitely lagged. Is that for good reason, or do you see some opportunity when it comes to the banks?
I think the lag there that you talk about is probably more confined to the smaller regional bank space when we look at the financials, and depending on whether you include REITs into the financials overall cohort or not. But I think the nuance there is that for the banking system overall, it's not just around kind of the in-place fundamentals or concerns around some of the risks which have emanated in March. It's also that investors are already kind of positioned. I would say that that's been one of the consensus overweights within the investor portfolios, particularly on the investment grade side globally. And that's also a sector where we do see a clear path for supply continuing to remain high as regional banks shift out of deposit funding into potentially tapping into wholesale markets. So it's this combination of existing positioning and the fact that there is a reason to think about continued supply. That's what's driving some of this underperformance within financials.
And Shri, I want to get your thoughts on this idea that a credit crunch could be looming for the economy. There was a note out from UBS earlier this week, and they noted that if you look at bank, commercial, and industrial loan growth, it looks on track to drop about 5% in the last 3 months of the year, and then about 10% in the first quarter of 2024. Those are near levels that are typically associated with a recession. And when you think about the possibility that credit could become less available, how big of a risk is that in your eyes?
I think we definitely have to solve for bank lending being more expensive and potentially too shorter tenors. So the term structure of funding and the cost of funding associated with banks is probably going to be different. But part of the reason why we're not seeing that escalate into something of a bigger concern, looking at the markets or the high yield market specifically, is that companies still have some time to put into place refinancing plans. I think if you look at the overall refinancing needs, it's pretty much negligible through the remainder of the year. It starts to build more gradually in 2024, but that's still around 6 to 7% of the outstanding debt that matures next year. It's only in 2025 that you see that real pickup. And if you're looking at this set of financial conditions, both in the context of banks and in the context of market cost of funding being this high by the time you get to the end of this year or early next year, that's when I think the credit market starts to really worry about access to financing and what that means for the lower quality companies.
And Alexandra, we only have about a minute left, but talk about what this moment means for active managers with all of these dislocations that are popping up in corners of the market.
Yeah, we really like active management right now. In fact, when you take a look at what's happening from the earnings perspective, you've seen 60% of the S&P 500 is, come out with their earnings and 70% of them have beat expectations, but there's so much nuance under the hood. And we think that the ability for active managers to really come in and provide liquidity when we see large air pockets, when that starts to happen, when you start to get to the late stages of the cycle, we want them to be able to, put dry powder to work. So we think this is going to be a really great market for active managers.
Alexandra Wilson-Elizondo, Sri Sankaran, and Zach Griffiths, everyone is sticking with us. And still ahead, it's the final spread. The week ahead, all eyes on the Fed ahead of its rate decision. Plus, it's Jobs Day in America. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, Euro area CPI out on Tuesday, along with earnings from Uber, Ford, and BP. Wednesday, it's the main event. We're talking about the Fed's rate decision. And then Thursday brings more earnings in the form of Apple and Peloton. Plus, we have the ECB's rate decision and another round of jobless claims. Then we'll round out the week on Friday with another big data point. We're talking about the U.S. April jobs report. But first, it's time now for the rapid fire round. 3 questions, 3 quick answers. Sri, I want to start with you. Does the Fed cut rates this year?
No.
Zach?
No.
Alexandra?
No.
Sri, does investment grade or junk outperform in 2023?
Investment grade.
Zach?
High yield.
Alexandra?
IG.
All right, guys, it's the final question. Sri, does the 2s-10s yield curve uninvert this year?
No.
Zach?
No.
Alexandra?
No.
All right, guys, great discussion. Really appreciate it on this Friday. My big thanks to Alexandra Wilson-Elizondo, Sri Sankaran, and Zach Griffiths. And of course, we're counting down to the Fed's May rate decision, many saying that this will be the last hike from the Fed. Let's take a quick look at the bond market. You're looking at the 10-year Treasury yield sitting at 3.44, a 2-year yield at just above 4%. We're going to see how that changes in the week ahead and what it means for that dynamic between the front end and the long end. Of course, that's been in focus all year, that yield curve deeply inverted. But for us, that does it for now. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.